Anxieties over planned reforms of Australia's banking system were heightened today as a Senate inquiry into competition in the sector started in Sydney. Reserve Bank Governor Glenn Stevens warned there could be unintended consequences from too much government intervention. But consumer groups were critical of the Reserve Bank's comments as they traded blows with the large retail banks over whether the government's reform package released yesterday will make a difference to interest rates. Business editor Greg Hoy reports.
Great expectations.
Well, we really think this is going to be a turning point in terms of building a more competitive banking system.
But as the Senate inquiry into competition in the banking sector opened at the New South Wales Parliament today, a more immediate focus was on alleged bank bastardry. In contention, were the banks justified in jacking up loan rates more than the Reserve Bank? The banks blame higher funding costs. Critics scoff and point to record profits.
Do you agree with the Treasurer's statement that the banks had no justification in lifting their interest rates above the official RBA cash rate in November?
I don't agree with that statement because I think we did have justification in the sense that our funding costs were rising. But I'd be fair to nuance the equation. What we hadn't done is created an understanding amongst the community that was the case.
Do you think the big four banks are ripping off Australians with interest rates on loans?
Well, Senator, it's a very sort of pejorative way of putting the question, isn't it? I'm not going to invite people to either feel ripped off or not. There's a set of facts about what's happened to funding costs.
The RBA doesn't seem to be particularly looking at the market from the point of view of consumers, and that's a great pity.
So far, the Senate inquiry has only further fuelled the melee over release yesterday of the Federal Treasurer's 10-point plan to revamp the banking system.
This has to be the start of a process. This has to be the beginning of a much wider and more comprehensive push to re-inject competition back into the sector.
We believe there is strong competition in Australian banking. We've seen the major banks, for example, cut a whole range of unpopular fees over the last 12 months, and they wouldn't have done that if they weren't trying to attract and retain customers.
Well, the banking industry would say that everything is fine, wouldn't they? And we really would like them to stop whinging about reform. The door for reform is now open. They need to get in the room.
It was the Treasurer himself who'd raised great expectations. He'd upend competition amongst the four big pillars of Australian banking.
The government is determined to see a new pillar in the banking system, particularly based on our mutual sector, particularly based on our credit unions and our building societies. They are safe and they're very competitive.
So did Wayne Swan deliver? That depends on who you ask.
This is a very, very substantial package. It empowers consumers to walk down the road to get a better deal. Very substantial measures to support lending by the smaller lenders, by the mutuals, by the regional banks, by the building societies.
The Treasurer now says that his banking package is going to reduce interest rates. This morning, the Assistant Treasurer, Bill Shorten, refused to back up that claim. Now, Bill Shorten is a smart guy. He knows that what Wayne Swan has done is he has oversold this package.
The Treasurer has proposed such measures as banning home loan exit fees, but only for new loans issued after mid-next year. That delay a frustration for consumer groups. Then there's to be an investigation of how to make loans more portable to make it easier to switch banks. Not soon enough, say the critics. There will also be greater disclosure required up front for bank fees and a boost to the power of the ACCC to stop banks signalling to each other any intention of raising rates.
The important thing is that the ACCC will, by this form of legislation, be empowered to at least conduct an investigation.
But to improve the access of smaller banks and second-tier lenders to wholesale funding, their wish that the government ramp up its investment investment in residential mortgage-backed securities was granted, as was the application to allow lenders to sell to investors other securities known as covered bonds. And last but not least, the building societies and credit unions' wish to be allowed to call and market themselves as banks came true, and now government will help them promote this.
Changing the term authorised deposit-taking institution into authorised banking institution, which will help us explain to more Australians that credit unions and building societies and banks all meet the same standards and all have the same regulatory protections to really hit the accelerator on growth and hopefully increase the pressure on the big banks.
The Reserve Bank Governor today expressing his concern over the government's plan to spend another $4 billion on mortgage-backed securities, taking to $20 billion its investment in funding for smaller banks and non-bank lenders since the onset of the global financial crisis.
Take due care with all these ideas because there can be, and there usually are, from most policy interventions, unintended consequences down the track.
One bank critic had to be forcibly ejected from today's hearing in Sydney.
It's fraud.
Sorry,
making money by fraud is stealing.
Order.
You cannot have variable interest rates. It is the biggest fraud ever to be perpetrated on this country. And these people are thieves. Variable interest rates. It's illegal.
With emotions running high on the subject of competition in the Australian banking sector, and as debate continues over the government's proposed reforms and the likely effect on them of a sensitive Senate inquiry, there's surely one thing you can bank on. There's a lot more heckling to come.
We made $4.6 billion profit in the year ending 30 September this year. That is a big number, there's no question. I can't sit here and say 4.6 billion is not a big number. But what we look at it from is what's the return on the equity that our shareholders have put into the business.
Business editor Greg Hoy.